10-year note treasury yields see a big move higher after moving significantly lower yesterday. Recall yesterday we saw yields go all the way down to 168. Clearly a risk-off trade. We saw equities decline. We saw flight to quality bid to bonds, and that drove yields lower. Well, today we saw kind of the reverse. We saw yields moving higher after a stronger ADP. And then after the Fed chair began talking, he started talking about maybe the Fed being more aggressive, looking at raising rates only 25 basis points at the March meeting, which, recall, had priced in some odds of a 50 basis point hike, but that is no longer seems to be the case. But then holding out for if the economy continues to move at the pace that it is, if inflation continues to go higher, the Fed will be more aggressive, even throwing out there the idea of throwing a 50 basis point hike somewhere down the road if needed. So right now the Fed looks to act aggressive to raise rates. The Treasury market, which had seen yields decline significantly yesterday, saw a big reversal higher, and today we saw them trade up all the way up to 190, and that's right around where we settled on the day, 22 basis points higher than yesterday's low. Now, what does this all mean for volatility? Well, if you check out that CVOL index over at cmegroup.com, you will notice a massive spike in volatility. Yesterday, we saw it move up to levels not seen since the spring of 2020. Yes, since the onset of COVID, and we saw those crazy volatility marks way back then. We got up to as high as there. Certainly didn't get to those peaks that we saw back in the spring of 2020, but it's the highest since then. And really, it reflects the market and the economy all in one. A lot of risk out there, certainly a lot of uncertainty, still geopolitical tensions, central bank risks. You know, what are these central banks going to do to get out of the mess that they created after COVID? So ultimately, higher volatility means we're going to continue to see wider price ranges. That's going to be bigger moves in yield, high and low. And right now, while we're off those extreme highs, we do remain elevated. So volatility remains running high, despite the fact that we are off those extreme highs. Now, lastly, what do we have the rest of the week? Well, Mr. Powell will speak again tomorrow to the Senate Banking Committee. Likely will echo a lot of what he said today, but there's Q&A and some new one-liners, some new headlines may come out. But clearly, the Fed chairman preparing the market for what is to come, and that's higher rates and possibly a more aggressive Fed than is priced in. Secondly, we have the claims number. What is the claims number? Well, it's that in-the-moment look at the jobs. Right now, we're looking at claims to be about 225,000 new filings from last week. That is still elevated. I think that right now the Fed and other economists would like to see that number get back below 200,000, a level it spent very little time below since the onset of COVID. And lastly, everyone's going to be forward looking to Friday's non-farm payroll number, which is expected to come in north of 400,000 new jobs, likely somewhere in the ballpark of where we saw it last week. Clearly, the Fed has already talked about the job market being very strong. It is a tight labor market, but at this point, that is not going to be a reason why they would not raise rates. And tomorrow's number, if it comes in as expected, will likely play along with that scenario. So right now, 10-year note yield seeing a big move yesterday and another big follow-up move higher today as we set up for Friday's non-farm payroll.